What if you could look at any RV park listing and know in minutes whether it's going to make you money? Not guess, not hope. No. That's exactly what this workshop is going to teach you. By the end, you'll have the same system I use to find profitable parks, run the numbers with confidence, and make offers that make sense. And that's without overpaying, without guessing, and without needing to hire anyone. This is your path to owning an asset that generates real income, month after month. I'm AJ Kukreja. I've been a real estate investor for 2 decades. I've owned and operated an RV park, and I've seen what separates a winner from a dud. Let's go. Let's start where most investors make their first mistake. They believe the numbers they were given. So you find a deal on Crexy or LoopNet. The numbers look interesting, but then the questions start. Is it a good deal? What should I offer? How will I finance it? Do I have enough down payment? Those same questions kept me up at night too. I'm going to share what took me years to figure out, so you don't have to wait that long. But first, there are 2 types of investors in this market, and the difference between them is the difference between a deal and a disaster. The first investor trusts the numbers he's handed, moves fast, falls in love with the deal, buys it. Then a few months later, wonders what went wrong. The second investor ran her own numbers, normalized the NOI, made an offer 400K below asking. The agent pushed back, but she justified her offer with financial metrics. The broker takes her seriously. They settled at 300K below asking. And 6 months later, she's looking for her next one. The only difference between the 2 investors is that she had a process that you're going to learn very soon. Here's something most investors don't know. In many states, sellers aren't required by law to volunteer information. These are called non-disclosure states. If the septic is failing, AC needs replacing, a zoning issue is pending, they don't have to tell you. As long as they don't lie directly to you, they are legally in the clear. Now, I'm not saying that sellers are dishonest. I'm saying that the law doesn't require them to be your accountant. So, you trust the numbers, then reality arrives. Your lender finds something wrong and backs out. Or worse, you close and 6 months later, you cash flow negative and looking to exit, even at a loss. The good news is, none of these are hidden from a trained eye, if you know where to look. Real example. I was analyzing an RV park, solid location, reasonable price. The offering memorandum, or the OM, showed a gross income of $480,000. Then I asked for the T12, which is the trailing 12-month profit and loss statement. The gross income there, $400,000. It was inflated in the OM by $80,000, 20% more. Same expenses. At an 8% cap rate, that's like adding $1 million to the asking price. Completely legal. Now, the OM is built to make the deal look good. That's its job. The pro forma financials is the seller's best case scenario, and neither one should be trusted. The T12 is your real starting point, always requested, but never trusted, because it almost always needs adjusting. And while you're at it, ask for the prior year's P&L as well. 2-3 years of data tells you a story that 1 year cannot. Also, ask for occupancy by month. Seasonality can make or break an RV park. An RV park that looks great annually might be running at 30% occupancy for 4 months of the year. So the monthly occupancy and the yearly P&Ls tell you whether the recent T12 reflects a real trend or just caught a lucky summer. Most sellers will provide you all of the above without hesitation. And if they hesitate, that's information too. Underwriting. Boring word, right? Insurance companies, they use it to manage risk. Lenders use it to make sure they get their money back. But for you, the investor, it means something different. It means knowing if a deal is a winner before you commit a single dollar. By the way, do you know what makes RV parks such a great investment? It's the most fun you'll have investing in real estate. Okay, moving on. Think of a 50-site RV park. Every site at $40 a night, fully occupied all year. Multiply it all together, and that's your gross potential income, your GPI, your theoretical maximum. Nobody hits it. Then subtract vacancy. Then add other income, laundry, storage, camp store. And what's left is the effective gross income, the EGI. It's what the property actually collects. That's your real top line. By the way, in this workshop, when I say gross income, I always mean EGI and vice versa. So now, from the EGI, subtract the operating expenses. And these expenses are what's necessary for running the business. That could be management, payroll, repairs and maintenance, utilities, insurance, property taxes, and some others. What does not belong? Debt service. This is the loan payments on the property, depreciation, sales tax, and the owner's personal expenses. And what's left over is the net operating income, the NOI. The NOI is one of the 5 key metrics that help you evaluate the deal. Think of NOI as the heartbeat of the property. Every other metric that we're about to cover comes from this one number. If NOI is wrong, everything is wrong. It's like a healthy heartbeat. Everything is working. Week 1, nothing saves you. Not the location, not the market, not the price. But here's the problem. The seller's NOI is almost always optimistic, sometimes dramatically. I've seen deals where the seller's stated NOI was nearly 50% more than the real number. Why is that? Well, a lot of times the owner self-manages, so there's no management fee in the expenses. Deferred maintenance the year before listing so that repairs and maintenance look artificially low. And they are. Capital expenditure, or CapEx, also never appears in the financials, even though it's a real cost. What if a central AC goes down in a year? None of that is lying. It's just how owner-operated parks present themselves. Your job is to build your own NOI, one that reflects what it would cost you to run the business. And later, I'll show you how to exactly rebuild the NOI. But next, one number that helps you compare any two similar deals immediately. Let's say you find a $1 million and a $2 million park. Which one is a better deal? The capitalization rate, or the cap rate, can tell you. The cap rate is the NOI divided by the purchase price. So a $100,000 NOI on a $1 million property is a 10% cap rate. In general, the higher the cap rate, the less you are paying for it. The lower the cap rate, the more you're paying for it. So ideally, you want to buy at a high cap rate and sell at a low cap rate. The cap rate is also tied to the property risk. A couple of months ago, a friend of mine came to me and said, AJ, 14% cap rate, unbelievable deal. I wondered, why hasn't anybody else bought it? I did some digging. It had some old cabins and a lot of deferred maintenance, aging infrastructure. The market had already priced in the problems. He just hadn't looked yet. So a riskier asset will usually have a higher cap rate. A Class A multifamily building, on the other hand, will have a lower cap rate. Know the normal range for cap rates in your market. It'll serve you well. So you find a deal at 18% cap rate, ask why nobody bought it. 4% cap, maybe they're asking you to overpay. Cap rate is useful, but it tells you nothing about whether a lender will fund it or not. And that's next. And it's the number that saves you from a deal that may look good until the lender kills it. The lender looks at DSCR, the debt service coverage ratio, and it's the NOI divided by the annual loan payments. So a 1.35 DSCR means that the property earns $1.35 for every dollar of debt. Your lender's minimum DSCR is likely 1.25. That's their floor for rejection, not their comfort zone. I had a client who had a deal at 1.3 DSCR. Lender said yes at first, then they stress tested every assumption. Occupancy dropped in their model, interest rates went up. They came back with a loan smaller than they had agreed on. My client had to come up with an extra $140,000 at closing that he hadn't planned for. The deal almost fell apart. Not because it was a bad deal, but there was not enough cushion. The extra cushion is the difference between a smooth close and a bad phone call from your lender. And not only that, it also determines what you actually put in your pocket. And that's next. So after the mortgage and the operating expenses are paid, how much is actually left? That's the net profit. It's what you actually make after every expense and all the loan payments are made. Now that should be enough to know if the deal works, right? Not necessarily. An investor was genuinely proud of a deal he'd closed. Great cap rate, strong DSCR, he tells me. I asked him what his cash on cash return was. Long pause. He hadn't calculated it. It turned out that his 35% down payment was earning about 4% annually. He could have put that money in a CD with zero stress and done almost as well. Cash on cash return is the net profit divided by your down payment, your actual return on the money you put in. 10% cash on cash means every 100K you invested returns 10K a year. And if the deal doesn't beat your cost of capital, why take on the risk? So in summary, here are your 5 key metrics. Know them well. Take a screenshot if you like, but first, let me adjust my face to my good side. You now have all 5 metrics, but every number you just ran came from the seller. And before we fix that, let's run 5 quick hacks that filter any deal under 2 minutes. Most investors spend hours on deals that should have been dead in 30 seconds. You can do these 5 hacks from the listing and the OM before you call the broker, before you request the T12, before you open a spreadsheet. They cut through the noise fast, so you can spend more times on deals that actually work. The first one is the 1% rule. If the monthly gross income is close to or more than 1% of the purchase price, then it's likely a good deal. This hack does not even need a formula. Just take the asking price, cross off the last 2 zeros, and that's the monthly gross income you're looking for. For example, if a $2.5 million park shows roughly $25,000 a month in gross income, it's likely a good deal. If it doesn't pass, it doesn't mean it's a bad deal. It just means that it may not be a stellar one. This rule works best in a normal interest rate environment, roughly 5 to 12%. Outside of that, don't use it. So if the 1% rule tells you if it's a good deal or not, the next one tells you if it's a bad one or not. And it's also under 10 seconds. For the 10x rule, you need to look at the gross rent multiplier, the GRM. That's the asking price divided by annual gross income. Ideally, you want the GRM to be under 10. You don't need a calculator for this one either. Just take the annual gross income and add a 0 to it. If the asking price is more than that, then it's likely overpriced. For example, $1.5 million asking price, $100,000 in annual gross income. That's 15 GRM. Expensive. It's not an automatic no. It could be a Class A asset, so you can find a low financing rate on it. It could also be seller financed. But you need to know that you're starting from expensive. Quick note here, the 10x rule uses the annual gross income compared to the 1% rule that uses the monthly gross income. So, 2 hacks, 20 seconds, no spreadsheet. The next one might need a calculator, but it's a quick way to tell whether you can get your deal financed. Now, the DSCR is something that you normally have to calculate, put in a spreadsheet. Here's the estimate that you can run quickly on your calculator or in your head. No need to know what kind of financing you can get, the loan to value or the down payment or the amortization schedule. Just pull out your calculator, multiply the asking price by the interest rate, then divide the NOI by that number. 30 seconds. If you get anything above 1.5, good breathing room. Between 1.25 to 1.5, worth a closer look. Below 1.25, lending risk. Now, this is just a rough DSCR estimate, but a good one to find out early. So now we have 3 hacks, all under a minute. The next one will show you if the P&L has been tampered with, and that's the expense ratio flag. Seller agents know exactly which expenses to cut in order to make the NOI look bigger, so they can ask for a higher price. But this hack catches it every time. On your calculator, divide the operating expenses by the gross income. Expressed as a percentage, that's the expense ratio. Below 30%, something's missing. Management, CapEx, repairs and maintenance are low, left out on purpose. And now NOI is inflated, and what you're looking at is fiction. Between 35 to 65%, it's normal. Above 70%, mismanagement or a high utilities expense or something else. This could be an advantage for you, but if you're a good operator, because it leaves a lot of room to add value. That was another easy check. However, the last one is the easiest one yet, and it tells you whether you're losing money from day one. You may recall that the cap rate is the NOI divided by the purchase price. For this hack, if the cap rate is lower than your interest rate, you're likely losing money from day one. That's called negative leverage. Simply compare the cap rate to the rate on your loan. Cap rate below your interest rate, you're likely paying your lender more than the asset earns. No need to even calculate the DSCR. You're underwater before your first repair bill. And if they're about equal, the deal would barely break even. What you want is a spread where the cap rate is above your interest rate. A 12% cap versus 8% interest rate, the asset earns 4 points more than your debt costs. That gap is your cushion and your profit. And that's called positive leverage. So there you go. 5 easy hacks you can do in a minute that tell you if a deal is worth pursuing. I've summarized them on this slide. However, you need to know that every number that you just used came from the seller. In the next module, let's get to the actual numbers. By the way, we're more than halfway done. Are we having fun yet? Let's talk about normalizing the financials. Normalizing or adjusting the NOI means putting in numbers that make sense to you as a buyer. Your job is to rebuild the NOI, one that reflects what it costs you to run it. Here are 4 typical substitutions to financials that I run on every single deal. On a recent deal I analyzed, here's what I found. Management fees was listed at $3,500, under 2% of income. That's low. And that's because the owner managed it himself. The day I close, he goes home and I'll be paying the manager. So I normalize the management fee to 10%. That's about $28,400 in my example. Repairs and maintenance was $4,200 for the year, down 60% from a year ago. Classic pre-sale deferred maintenance. The solution? Just use a prior year number, 10,500, or a percentage of the gross income, like 5%. On their financials, CapEx was also 0. What if the septic system needs to be repaired? So I added about 3% of income, about 8,500. Because those repairs are coming, whether you budget for it or not. Property taxes are often understated. especially in counties or state where you have to disclose the purchase price. Do your research and adjust accordingly. For my analysis, I increased it by 20%. So after making 4 adjustments, and that's $41,200 cut from the seller stated NOI, at a 10% cap rate, that's $412,000 in overpayment risk. That's not a rounding error. So now you have a real NOI, and you're almost ready to calculate your offer. But before you make that call, you need to break the deal on purpose. So now you have a more realistic NOI, but let's see how it behaves under stress. I call this the bad day test, because deals don't fall apart on good days. Try these 3 things. Cut occupancy by 10 to 15% and see what happens to your debt coverage. A park that pencils at 75% occupancy can survive a slow season, but one that only works at 95%, one bad summer, and you're paying out of pocket. Then try adding 1 to 2% to your interest rate, especially important if it's an adjustable rate loan. Even on a fixed rate, you may have a balloon payment coming and need to refinance in 3 years when the rates could be higher. Then try raising expenses 10 to 15%. Insurance rates have gone up every year for the last 4 years in most markets. Repairs and maintenance always creep up. So build the cushion now, or the market hands you the bill later. You are now left with only 2 questions and 1 answer. For your RV park to make good money, 2 metrics should clear at the same time after you've normalized the financials. Question 1. Is your DSCR, that's now the normalized NOI, divided by your annual loan payments at or above 1.35? That's your minimum target, not theirs or the lender's. Question 2. Is your cash-on-cash return, that is your new net profit, divided by your down payment at or above 10%, or whatever your target is? If both clear, go. If one fails, it's on the fence. If both fail, likely no go. But there's hope. I'm going to show you how you can still structure your offer to make it work. And that's next. Now, a conditional deal doesn't mean dead. It means restructure. And you have at least 3 levers that you can adjust. The most obvious one is lower the price till the DSCR clears. Simple enough. But what if the seller objects to a lowball offer? 2 is seller financing. Let's say the seller is adamant about the purchase price, but your DSCR and or your cash-on-cash return fails. What if you call the seller and ask one question? Would you consider carrying a portion of your purchase price so we can make this deal work? Let's say he's 71. He doesn't need all the proceeds as a lump sum and likes the idea of a monthly income. And say you structured a deal where the bank covers 65% at 8% interest rate and he carries 25% at 5% interest rate. The blended rate just dropped over a full point. So the DSCR clears. Cash on cash return jumps from 6% to 11%. And now you have a deal. That's the power of seller financing. Don't be afraid to ask for it, especially if it's the only way to save the deal. Lever 3, you can come up with more down payment to lower the DSCR. So the lender is happy, but you may not be happy because it lowers your cash on cash return. So let's try a mix of all 3, and that's next. Let's look at different ways to make an offer. Same property, dramatically different structures. Option 1, here you ratchet down the purchase price till the DSCR and cash on cash return clears. That's your maximum allowable offer, or MAO. So let's say you make that offer, assuming bank financing 25 to 30% down, DSCR passes, COC is good, your lender pats you on the back, but the seller might not be happy if it's too far from their asking price. He might not take it. Option 2, partial seller carry. Fixes DSCR and cash on cash simultaneously. Best when the deal fails bank only, but the seller is motivated. like the 71-year-old who wanted monthly income, as in the previous example. Bank covered 65% of purchase price at 8% interest rate. Seller carried 25% at 5%. The blended rate dropped up below the market, and everyone was happy. Option 3 is full seller financing. The seller wants his full purchase price, is willing to work with you on terms like interest rate and interest-only payments. The seller needs a steady income or understands that capital gains tax could take a bite out of his profit. No bank, no appraisal risk. Seller becomes the lender. Maximum DSCR and cash-on-cash return. Try all three. And if none of these work and the seller won't budge, your underwriting just saved you from a very expensive mistake. A good offer structure requires you to be confident with your numbers. I've shown you some numerical example, and I'm also going to show you how I actually do it. But first, let's look at how to turn an opportunity into a gold mine. I walked an RV park once where the owner hadn't raised rates for 4 years. My guests are loyal, he said. I don't want to push them out. I get it. But the market had moved on. Parks nearby were at $40 to $50 more monthly per site. At 100 sites, $40 per site per month, that's $48,000 a year. At 10% cap rate, that's almost $500,000 in unrealized value. There are many more ways to add value and increase NOI. Improving occupancy from 80 to 90% is almost always a management problem, not a real estate problem. Expense reduction. Convert owner-paid utilities to ratio billing. It moves the cost off your P&L and to your guests permanently. Additional revenue, laundry, self-storage, covered parking, you get the idea. Some owner-operated parks leave all of this completely untouched, and that's your opportunity. However, a few words of caution here. Don't pay the seller for value that you intend to create. That upside is your return and your exit, not theirs. So now you have the full framework. You could go underwrite a deal right now. What I'm going to show you next is how I do it. Hey, by the way, pop quiz. Who is the most popular musician at RV parks? Axl Rose. Welcome to the jungle. Right. A demo. Here it is. Okay, so this is my underwriting tool. It's RVP Underwriter at rvpunderwriter.com. And what you do here is you basically just drop in the files, the OM, the T12, or whatever you have, rent roll, anything and everything that you have. You can just put in here and click Analyze the deal. And what it's doing right now is going to read all the documents, and it's going to cross-check the documents too. It's going to cross-check the rent roll against the T12, and it's going to give me the seller numbers at first and see how they look. That's going to take about 10-15 seconds. And here we go. So these are the seller numbers on this particular deal. Everything looks like it checks out. It's got good cap rate, DSCR, cash on cash, everything passes, but it's saying it has caught 2 issues in these financials. So I'm going to say get the real numbers and underwrite this deal. I'm going to click on that, and that's going to take another 30-45 seconds or so. It's finishing up. And there you go, it's done. So here's the deal snapshot. It tells you what the property is about. And then the location is talking a little bit about the location. Then it's going to tell you the judgment calls it's made. It normalized the NOI to 250. And the reason for that is there was no CapEx reserve. It added that in. The insurance says it's going to go up. The property tax is going to go up a little bit. There was no legal and accounting. And the merchant bank fees, not that much difference. It's scaled with the occupancy. So let's look at the offers. Okay, so now it's saying the maximum allowable offer with conventional bank financing would be just a little shy of what the seller is asking. However, if the seller carries, you can exceed your thresholds for cash on cash return and the DSCR target, both of them. If the seller just carries 35%, we have 10% down. And then this, of course, is the full ask. It's always going to pass because the seller is being the bank here at 5% interest rate. So this would be helpful if the seller is asking too much. But in this case, it's pretty close to, the deal is pretty close to what it should be. So the verdict is saying go with offer 2 because there are some indications of a seller carry. So it's going to say go with offer 2. Now we can adjust the offer here. We can say, well, let's try occupancy 70%. You could do that if you wanted to and rerun the offer. Here are the top risks that it flagged. And here are the red flags. And now it's calculating the stress tests, saying at what interest rate you start losing money. So if you have your break even is at 12.5% and your break even occupancy is 73%. So occupancy drops below 73%, you'll start losing money. And here's the explanation of why it says the property tax will go up. It's saying Texas is a non-disclosure state, so the likelihood of it going up too much, it's not that high. But it's saying the insurance risk premium going up, that's definitely likely. Now it's saying all the ways you can add values. Like this is the landlord paying utilities, so bill back 50% of water and septic costs to tenants, and you could gain about 200,000 in value. If you increase the rates, it's below market right now, you can get another 55,000 NOI, and it just calculates what the potential could be. And now we're down to the report section. You can generate a one-pager PDF. You can save this deal so you can come back to it later. And you can also generate a full underwriting report. If you have the deal maker suite, you can have a deal memo for the lender, the investor deck, the Excel model, and the negotiation playbook. And I'm going to generate all these and show you what they say. Okay, so here are the reports. The first report you want to look at is the one-pager. You can give this one-pager to your friend, your partner, or any other investor. And then for the deal maker tier, it also generates a full underwriting report. So it's more than one page. So it basically gives you the entire summary of the whole underwriting that it did for you. And then we also have the LOI it generated. The LOI is based on the offer, the recommended offer 2 with the seller carry. And it fills everything in. It's a one-page LOI that you can hand off to the agent or the seller. And then we have the deal memo for a lender. You can hand this to a lender and it gives you a summary of what the offer is, the financing request, the property overview, the summary, the business plan, the market overview, the location demand drivers, and whatever the lender needs. If there's any risks, you can talk about, it talks about also what you can do to mitigate that risk. And finally, you have the negotiation playbook. It reads the deal as if you're negotiating with the seller, and it tells you what your leverage is, and it quantifies that leverage. And then also gives you an offer sequence. It says, okay, open with offer 2, and if they want to shorten the balloon, you can say, yeah, 5 years instead of 7. You can increase the down payment slightly towards 15%. So it talks about all that, and also talks about how you sell the seller carry to the seller. And if the deal stalls, it gives you some other creative structures that you can try, like earn out. And also some of the objection handling. So if seller says, blah, 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 my OM is 310, you say, you talk to the seller and negotiate with the seller politely as a trusted advisor, and that's what it does. And now let's take a look at the Excel spreadsheet. So this is for someone who wants to adjust the financial details and take control of the offer completely and the underwriting completely. So you have the capability of doing that. Now it fills in everything on its own based on the data that it was given. You never have to enter anything by hand. This is a huge time saver. And one of the main reasons why I did this, it would take me hours to do this. And now it generates it perfectly based on my template. It generated the 5 metrics, NOI, cap rate, DSCR for the 3 offers, 1, 2, 3. And it also has the quick hacks, the 1% rule, the gross rent multiplier. You can change the purchase price, you can change the interest rates, and it makes an effect immediately. For example, if you change the offer price here, make it 2.5 million, and boom, your DSCR just changed, cash on cash return changed instantly. And you have all these levers, and all these orange rows they're the ones that it normalized. So it increased the property taxes for offer 1, 2, and 3. It added the legal, professional, and the capex reserves that was missing. And you can see the effect of the NOI that was 283 reported in the T12, and it normalized it down to 250. Then it shows you the debt service, the total debt stack, how much debt you're paying every year, um, and the annual profit that you make every year. Not only that, it has a value add that you can get by implementing the utilities. So your NOI, as you're normalizing, is dropping, and then after you purchase it, you can raise the NOI back by rate optimization, occupancy upside, and stabilizing the NOI. The assumptions for the financials, and based on those assumptions, the pro forma that it created. So how your annual NOI is increasing as you add the value. Year 5, you're refinancing. Your debt to value is going down, goes back up after the refi, and starts going back down again as your NOI goes up. And another tab on your returns. If you have investors, you can tell them this is the capital you need. This is the preferred investors got paid. This is the IRR they can expect. And the returns for the preferred investors versus the common equity of the GP sponsors. And that is the last report. So that's the RVP Underwriter. And it does 3 main things. It will read the documents. Right when you drop in the files, there's no data entry involved. And then it'll do a live market research and then look at a snapshot of the deal and the location. And then it does the underwriting, where it gives you the verdict with the 3 types of offers that I talked about. The bank financing, the partial seller carry, and the full seller carry. And then it does the reports, the LOI, the lender memo, and the Excel model. For the Excel model, it pulls all the data from the files that you uploaded. You don't have to manually enter anything. And then it'll give you the investor pitch deck and a negotiation playbook for that particular deal. And no account is required for a free initial look. And your first 5 full underwrites are completely free. Now you can do this manually. I've shown you how to do it, but I know what you're thinking. Knowing how to do something and having the experience to do it right are not the same thing. Doing it by hand would have taken about 4 hours for the analysis alone. One wrong number, management left out, capex at 0, and it cascades silently through everything. And you won't know until after closing. And by then, it's 6 figures gone. So that never happens. I turned everything you learned today into this tool you just watched. So that's the choice on every deal from here. 4 hours in hope, or 2 minutes, start to finish, with no stress. And your first look at a deal is always free. So that's the training. You know more about underwriting these deals than most people who buy them. You can scan this QR code with your phone, or if you're on your phone, go to rvpunderwriter.com. Run one deal through it this week while today's material is still fresh, because the method sticks when you use it on a live property. And if it catches something or does something wrong, I genuinely want to hear about it. Again, my name is AJ. I did not learn this from a course. 20 years of real estate experience, single family, multifamily, commercial. I bought an RV park at a cap rate of 10, ran it through 2 full seasons, dealt with every problem that doesn't show up in due diligence, and exited at a cap rate of 6. Before that, I had a career in high tech, leading product portfolios that did 200 million plus in revenue, where one wrong assumption cost real money. This is it. I won't be asking you to sign up for a masterclass, then upsell you. I have given you all the information to do it yourself and shown you all my secrets. This is just the part where you stop doing it the slow way. And if you ever want to go deeper, you can find me on Instagram at AJ Kukrecha or email aj@sugarpinepm.com. Stop guessing, start closing. I'll see you on the next deal. Thanks again for watching. And please take some time to read this important disclaimer.